Well, it is one of Mike's favorite times of the year. Chad Smith here, Mike Eklund, and we are talking through our 2020 outlook. And we framed it this time, the episode, around frequently asked questions that we get. Because people are always very concerned about their investment portfolio, even though that's only one piece of the overall financial planning approach that we take. One particular question that we hear over and over in a lot of scenarios, but really the last 10 years that has been so strong, is we've hit all-time highs, multiple all-time highs. We know a recession is on the horizon. How should we be changing things here? What's happened, basically?
What's happened is 2019 was an unbelievable year for an investor. So it doesn't matter if you invested in stocks or bonds, you did very well last year. And so rewind where you were at the end of 2018. We just had a 20% drop in the market. There was concerns over recession, trade wars, geopolitical concerns. Fast forward a year right now, and we're almost at the same place again. So there's always going to be risks. There's always to be concerns, and that's why you get paid more to invest, is because there are risks involved. It's difficult to predict the perfect time. I just know over the long term, a globally diversified portfolio goes up, and you're compensated for that risk.
And we know that our emotions play crazy tricks on us when we're investing, right? So we felt very differently at the end of 2018 compared to how we feel now. However, there are still a lot of uncertainties hanging over us. We're in an election year, for one. We have Brexit decisions still hanging out there, potential war threats, so trade talks. I mean, a lot of things to worry about. So how do we make the best decisions around our investment strategy so that we're not just making these knee-jerk, extreme moves in our portfolio?
Well, that's a good point. The first thing, as you mentioned, you should have an investment strategy. And without that, you don't know where to start. And that strategy should be globally diversified. As I comment to some folks, if you're holding something in your portfolio you don't like, it means you're diversified. And that's how it should work. You can't always pick all the winners. If I had a crystal ball 10 years ago, I would just own large U.S. stocks, but I did not. And so those international stocks, which didn't do as well, they served a purpose. They kept me diversified.
So you mentioned international stocks. We talked through a lot of these ideas and the valuation focus and what the experts are predicting in our podcast, much longer episode there. But international stocks in particular, people really like the U.S. stocks these days.
They do.
And they're not seeing a lot of benefit necessarily to having that diversified portfolio. So how do we respond in those situations?
First of all, I rewind to December 2009, where everyone said, why own U.S. stocks? And so 10 years later, now it's why own international stocks. So it's going to happen again. And that's the internet investing. You have to own stuff you don't like, U.S., international, large, small, and that's going to help you out over the long term. Because over the last 20 years, the U.S. stocks have not been the best place to invest. It's actually been emerging markets. So,
yeah, markets run in cycles.
They do.
So if we're putting all of this together, Mike, we're thinking about all the uncertainties, what's to come, what has happened, how it makes us feel. What do some of the experts have to say about this, and what are they predicting going forward?
Yeah, there's no perfect predictor. I mean, there's no one that has the crystal ball, but there are a number of well-respected financial firms that give estimates of what they think is going to happen over the next 10 years. And so we'll have a link in the show notes to Morningstar compiles a consolidated list. But if you look at 5 or 6 firms that they polled in their article, all of them expect higher returns for international stocks than the U.S. stocks. For example, Vanguard expects almost 8% returns for international stocks versus 4 to 5% for U.S. stocks. So definitely the tilt more towards international, and then bonds more in the kind of 2 to 3% return. I think that's consistent across a number of these so-called experts.
Yet again, global diversification rules there. And then understanding where that fits in the context of your financial plan.
Yep.
We put so much emphasis on that here, and understanding and working and building customized plans so we know when you need cash, and then how much exposure you should have to risk, and how much you will sleep at night as a result of that.
Agreed. Focus on what you can control.
Very good. Well, thanks for joining us. Check us out, financialsymmetry.com, and we will see you next time.
Thank you.